Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her website, jugglingdynamite.com, and also at venablepark.com. Welcome back to the show, Danielle.
Thanks, Jim. Happy February.
Yes, and I wonder if they'll charge us extra because we live in BC and the government here has capped delivery fees for food if we ask for a nice meal for February 14th. I know Ontario also capped delivery fees charged to the restaurants at 15%. Do you have to pay a special Ontario fee for food deliveries there?
Well, you know what? I actually don't order any service that pays a 20 or 30% premium to the delivery, so I don't actually know. I know that they capped it because I thought it was capped at 15% because some were charging 30, and that's just outrageous. But since the pandemic has really brought attention to the strain on the local restaurants, of course, if we do order something, I always go and pick it up now. So I think that's the recommended procedure that most people should do if possible.
Yeah, well, now Skip the Dishes is adding a 99-cent BC fee because BC capped what they can charge restaurants. And then, of course, there's GST on top of that 99 cents, another 5 cents on top of that. This may be the most costly 99-cent fee a company has ever charged because of the bad publicity.
Well, it seems like, truthfully, instead of gouging it out of whatever net profit that the restaurants can make on their already low-margin business, if they put an additional fee that's absorbed by the consumer, at least that's a more honest way of reflecting the cost, and then the consumer can decide whether or not they want to, pay it, can afford to pay it, that sort of thing.
Right, and this $19 bill already had a $3 delivery fee. Why not just make it $4? But it sounds like BC is being singled out for some kind of punishment. Well, anyway, business is allowed to charge, I guess, whatever they can to be a successful model, and we'll see if the public agrees with it.
Don't forget DoorDash makes no net earnings, right? So the whole thing, it's kind of in the pot of these companies that have a lot of users but actually haven't made any net earnings yet. So it's all about monetizing the users, and that's the kind of business model that's putting out of business all the local suppliers. So it's a pretty toxic mix. When it gouges money out for the enterprise or the app, but at the expense of everything else.
Right, and as somebody said after one of those companies rolled out their IPO, how many millionaire pizza delivery people do you know?
Well, the thing is, this model of unprofitable IPOs, of course, is one of the things that's indicia of this speculative mania that's going on in the world's markets, and generally financial decisions all over right now. And, we've just hit, I was writing about this on the blog, that we've just hit this record amount of negative earning IPOs, even more than we had at the peak of the .com fiasco in 2000. 2020 saw the most offerings to the public with negative earnings. So it's really just another indicator. Something like 80% of global IPOs in 20 had negative earnings. So it's very typical, and people are paying 20, 30, 40 times revenue, even more, which is just nuts. It's got nothing to do with investment. It's all to do with getting rid of cash, like some kind of a hot potato that people are trying to toss at each other. But of course, as soon as you toss it to someone, they do it in exchange for your cash, right? So cash is never sidelined. It's always in the mix somewhere, and someone's holding it at any given time. So far, the zeitgeist of the day is that, cash doesn't yield much, so it's junk and you should give it away at any cost, at any price. And that's just a fool's errand. It's likely to just be the next, financial disaster waiting to happen. So it's just another example of the many that we have at the moment.
Do pensioners face an investment trapdoor trying to catch this market mania and maybe taking something that's in a very secure fund and putting it into something that's a lot more adventurous, or some people would say risky?
Well, there's a couple of things there. Yes, we're in this very frothy environment where the major indices, a fifth or 25% of trading volume on any given day is in a handful of penny stocks, and that's what's moving the major indices in these parabolic moves that we've seen in the last few months. So that's always another sign of great risk as well, because a lot of funds and ETFs and indices and portfolios managers, as I've explained before, are mandated to track the index, whether it's the S&P, whether it's the TSX, whether it's the NASDAQ. And so what they do is they buy and replicate exposure to that index regardless of how frothy or dangerous it is. So the fact is that the regular people, retirees, people who are approaching retirement, who are not trying to be really speculative and gambling and dangerous, are unfortunately riding shotgun with this same crowd at these same valuations in these same markets. And this is where it gets very dangerous. If it was just, a bunch of people trading on margin at Robinhood or various places with capital, in a fringe group of shares, that would be one thing. But it's actually infected the entire marketplace. And as I say, because there's such an amount of passive replicators or followers of these benchmarks, it is really it's not going to just deflate and hurt the speculators. It's also going to deflate and hurt the people who think they are being prudent. And that's when it gets very contagious, right? Because it's the indexes, it's the average people. We've discussed before, the bulk of people have very little savings. Mostly they have debt and very little savings. The people that have actually amassed some savings, many of them are not trying to be crazy with it. They are mindful of the risk to it, and they are trying to preserve principal. It's just that, unfortunately, the common wisdom right now is that you can do that with a diversified portfolio of these instruments, whether they be, growth stocks or dividend stocks or emerging market stocks, whatever they are. Ultimately, they're all infected with this same mania at the moment. And so when you've got them, price to revenue, price to earnings, price to book, price to asset value, any of that stuff is just at all-time highs. There's nothing, there's no way you can't see it if you're looking for it. It's just that most people are paid not to look for the risk. They're paid to just buy and hold, or tell their clients to buy and hold, and not try and actually actively manage the capital risk in each cycle. And so that's why people are mostly not tuned into it. But the few people on the buy side who are, not compensated just to get people into products, but actually to manage risk, and who don't consider, a loss with the index as a benchmark to be okay performance. There's a few of us that are actually absolute managers in the sense of we want to have positive gains year over year regardless of what the stock market's doing. So that group of people tend to be much more risk aware and much more less likely to toss cash at just anything and actually wait for an investment thesis. So, as I say, it's not possible to participate in equity markets today without being running alongside the madness of crowds, because that's the kind of environment we're in. But it is possible to not do that and to still focus on your personal discipline and protecting your principal and waiting for better entry opportunities. Because John Hussman just did this piece. I think everyone should read it. It's really remarkable. It's his monthly missive for February, and it's available on Hussman.com. But detached parabolas and open trapdoors, it's called. And basically, he just looks through the last 100 years and takes you to all the market mania times and what investors were saying at the time, what the rationale was for why price didn't matter, why historical patterns didn't matter, and it's extraordinarily reminiscent of what we're seeing right now. So I think there's a lot of wisdom to be had in pulling back and just sort of taking a top-down view.
Some people have said that we're into the same era as the 1920s where shoe-shine boys were giving investment advice, or perhaps go back to the 1600s and Tulip Mania. Are we seeing that kind of phenomena?
Actually worse, I think. I mean, I don't know, I wasn't around in the 1600s, but I've read a lot about the 20s, and valuation-wise we're actually worse. And certainly the average person that has no idea what they're doing in financial markets, that's, buying things on leverage. We've got this, the more recent or modern advent of the zero commission trading structure. Back in the 2000s, I remember well that the brokerage fees were coming down quite a bit, and they were all about enticing new people, the little guys, so to speak, to be able to trade like the professionals, so to speak. And then you had this whole, influx of financial attainment, financial media, encouraging people to be brave, to take risks, to act like the rich people do, and all this. And then the idea was that they too could win. Of course, it's just a sucker's rally, because it's, as we've seen, we have a lot of participants in the market today that are the high frequency trading crowd who are set up for minuscule profits, but they take pennies off of millions and millions of dollars of trades. They're not investing. They're not in there for the long haul. They're just transactional, and they're skimming as they go. That should be illegal, full stop, but it's been allowed by a very lax regulatory system. That, on top of the share buybacks that the big corporations have been allowed to do, again, should be stopped. Now, there is some hope, I think, in all the mayhem that's happened recently, in the sense of the Robinhood thing. As I've explained before, Robinhood's not the only one who's been pretending that they're, enticing users. Again, they have no actual earnings, right? It's the same model. It's the app-based entice users to abuse them. The users are the product. They're not actually the customer. And so same thing. So what we saw there is, the little guy thinks that they're trading like the pros, swimming with the big fish, but actually the app itself is making its money by selling them like food to the big sharks, right? That are the hedge funds and the HFTs of the world, the high frequency trading firms, which actually were paying, in Robinhood's case, paid them more than $400 million in 2020 just to access this client flow so they could trade ahead of it. So it is, and then of course, as we saw, once the Reddit platform gets involved and the little traders try to band together to sort of fight back against the machine, what ends up happening is the powers that be just shut them down. Now, there's a class action lawsuit that's come out of that, and I think there'll be all kinds of lawsuits that are after this, because people lost a lot of money, especially last week in the online trading thing. So what happens is now there's a scapegoat to be found, right? Who's to blame for these losses? Now, a huge part of the losses is to do with the reckless behaviors that were going on and the people that were borrowing money, using record amounts of options, which is another way to lever your risk exposure, to these extraordinarily overpriced securities, which have nothing to do with their earnings, nothing to do with their fundamentals or their investment prospects. It's all a gambling mechanism. So they were doing that in the first place, which has always been ultimately reckless and self-destructive in the end. But now they want to know who to blame. So there's many people to blame. There's the dereliction of duty in the regulators and the legislators who have let this madness go on for the last 15 years. Then there's the apps that were, suckering them in, telling them that they were there to help them steal from the rich, when in fact they were stealing from the poor to give to the rich. So there's all this marketing and mayhem that's gone on. It's really been a fool's errand. But ultimately, there's now all these class action lawsuits against the app itself, against the hedge fund investors behind it. And I think this may actually have a public function in bringing to light what a sordid and ridiculously unfair, rigged system this is. Ultimately, it's the opposite of free markets. There's no investing in this. This isn't investing markets. This has just turned the whole thing into an absolute, charade of bonkerness. And so that's why I think they've destroyed the actual utility of free capital markets that are supposed to help, access financing for legitimate business and support of real enterprises and productivity enhancement in the economy, and they've turned it into this big casino game. Now, the incoming administration is interesting. I think, administrations sort of rise to the challenge at which they're handed. So the Biden administration, for example, is coming in the midst of this greatest recession since the 1930s, the pandemic, of course, being this great health challenge that's ongoing and not likely to be quickly curtailed, even with the vaccines that are rolling out. And you've got that married with this mass speculative wave, the worst and highest in history, where margin debt to GDP, for example, is just gone parabolic since March and is above any other peak we've ever seen. And then you've got these things like SPACs, which are these special purpose acquisition companies. This is another end run around any sort of regulatory intelligence, which is just people, celebrities, basically going to the public and raising funds for sort of like a blank check, like give us your money and we'll look for something, anything to buy in the next couple of years. And in the meantime, they're going to collect fees. So it's just abuse of a trust is the dominant model. I think we've talked about this before. And so you get, a call to arms, so to speak. And so Biden is, in fact, putting some people in roles that threaten this status quo system. Gary Gensler, for example, is known as an actual tough regulator, and he's Biden's pick to head the SEC. And this is very important because the SEC can have influence over the high frequency trading rules, about share buybacks, which is this other atrocity that's caused so much imbalance in our system, wasted capital and malallocation. And then you've got, Elizabeth Warren, for example, who was an actual, legitimate regulator for little people against the big players, when she helped found the Consumer Protection Agency. She's now going to be on the Senate Committee on Finance, which covers tax and revenue policy, and she's proposed, this wealth tax on these people that make over, that have over $50 million and more, and also financial transaction tax, which will help on some of this stuff. And then you've got, I've been long saying that we're overdue for antitrust prosecutions because of all the way in which these large participants have cornered markets and squelched any legitimate competition or equality of opportunity. And, Amy Klobuchar is now the chair of the Senate Judiciary Committee, and she's been running on an antitrust reform bill platform for some time. So if we get the antitrust, we get the actual regulation coming in at the SEC, we get, financial transaction tax coming out of the Senate Banking Committee. Now we've got Janet Yellen heading up the Treasury, and she's talking about how to redress this, imbalance in favor of the, quote, little guy again. So I think potentially we have the means, that coupled with all the lawsuits against the offending players, of getting some actual reform in this Wild West mess that we call our financial markets.
We'll have more with Danielle Park right after this.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Danielle Park. Danielle, Bitcoin says it's safer than gold, better than gold. You can trade it on your phone. Who needs gold anymore? Something you could bury in your backyard if you really wanted to or felt safe doing that. Or is it an either or is this again something that's just fascinated people because it goes up and down so fast you can make a huge profit in a few seconds?
Well, to me, it's part and parcel of this same era that we're talking about. So this, whether or not blockchain has some fundamental value as a ledger of exchange and commerce in the world, that's a separate issue. The reality is that the cryptocurrency mania that we've seen has really come to a fevered pitch at the same time as all these other factors, right? So you've got the same kind of behaviors, the same kind of leverage, the same kind of extreme risk-taking based on these belief systems, which are actually not likely to hold up over time. So, of course, depending on the rationale for buying cryptocurrencies, some people are proponents of it being a currency, which is a farce because it's got none of the hallmarks required to have a benchmark currency. It has extraordinary volatility. No one would ever be able to use it as a medium of exchange in that kind of, in any sort of serious way. It's not much of a store of value, clearly. I mean, you could say that bullion of silver or gold or things that are used in industrial processes like copper, for example, or whatever, they actually have a utility in the real world. Water, I've often argued water is actually the most valuable commodity. Those are tangible with real world uses. When you're talking about something that only exists in the internet, then you're into a whole other level of esotericness. So I think cryptocurrencies are also going to be, and they're also talking about regulating them. There was a speech out of the EU this week. So I think regulators in general are going to focus attention on these highly speculative activities which are not generating tax revenue. That's the other function here, is that, with all the checks being written thanks to the coronavirus and the downturn in the workforce and the overall economy, there's a lot of stuff that may have got away with these, transactions that weren't being attached to tax in the world that are no longer, can be tolerated. So I think that there's a lot of reason for controls and focus on this particular area. And I think, as I've said before, you just look at what goes on in a meltdown phase in the market. We've seen several of them in the last few years, where there is all of a sudden a failure of belief in the central bank powers, for example, to keep things elevated, which is a belief system. It's not a reality. They actually don't have enough money to buy up everything in the world, especially at these asset prices, when things are so egregiously valued. So it's only just a faith. It's a belief. But once that faith is lost, and it does periodically come where people lose faith that can be held up, then you see mass selling. And what happens is it's forced selling, right? Because margin calls are made. People that have these levered bets, they have to, and we saw that with Robinhood, how they started getting calls for margin on the regulators who are looking at their exposure as an institution, as a firm, and saying, you have to raise cash. So then they do things like prevent trading or force selling or need cash injections from other places and start making margin calls on their customers. So I think you're going to see more of that. And we had, in March, for example, when the markets were melting down, everything was melting down. It wasn't just stocks and it wasn't just commodities. In real hard, rocks and trees things, it was also things like cryptocurrencies. So again, this is my, the general premise again is you've got cash, which is not trash, which is extraordinarily valuable, and when managed appropriately is the difference between financial success over time and financial repeated failure of financial efforts. So the ability to keep cash and liquidity, the ability to have a discipline around your debt and how you're spending, the ability to be able to buy things when everyone else is forced to sell them, that is all the fundamental principles of how you get actual financial stability over time. And I think the U.S. dollar is still the benchmark. There's no rival that's anywhere close to being able to provide the medium of exchange, the trade currency, and that the world uses. And so when you get a a rush into U.S. dollars when people start raising cash because they need to. For example, emerging markets have more debt in U.S. dollars now than they've ever had. They need to start selling assets and make payments in U.S. dollars. So you get a rush into the U.S. dollar, then everything else on the other end of the teeter-totter, which includes cryptocurrencies and commodities and equities and corporate debt, everything, other currencies, they all start coming down. And conversely, the same thing has happened as the U.S. dollar weakened between March into the fall. You saw those things rise. Now, an interesting thing has happened in the last couple of weeks where the U.S. dollar actually has found support in long-term strength. Around the 89.90 was the test that my partner Corey had outlined at the end of December, saying, there's a lot of support in the 89.90 88.89 level for the U.S. dollar index, which is the basket against the world of other trading mediums. And it, in fact, has held that support and is now, back over 91.58 today. So if we are into this next level of strengthening and we start to get disappointment on, how long the vaccines are taking and the fact that we may see, a recession renewed in the first quarter, but we may actually see the weakness in the economy continue into the second quarter, so the whole first half, which would be not surprising given the amount of lockdowns that are going on in the world today. You could easily get another risk-off phase where you get back into the slowing growth and slowing inflation phase in the second half of the year. And at that point, you're likely to see all these other things mean revert together. So it's, if you've been in this thinking you're in a new bull market, I would suggest that that's not based on reality in terms of the facts of where we are. If you're in it in some kind of a trading medium and thinking you're, just taking some risk along with the others here, just be aware that traditionally, that type of trading ends up in losses about 85% of the time. So make sure you're very careful in terms of what you're exposing, what you're risking, and what your rule set is. And for other people who don't want to, go to the casino with their life savings or, want to make sure that they're making an investment rather than a speculation, then, it's okay to just keep money in cash and in safe deposits, in treasury bills, and just wait for this madness to pass, because it will. If you just read the historical precedents, and as I said at the beginning, Hussman's piece is a great summary. Just go read that, do yourself a favor, and it'll give you a glimpse of where we are.
We'll have more with Danielle Park right after this.
Avin Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avin's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avinresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, do you think inflation is going to finally raise its ugly head?
Well, we've seen some inflation in things like the cost of goods. There's been some loss of supply in the shutdowns that have happened, with less, for example, imports coming from places like China. So there is some that restricted supply in some areas can cause inflation. We've seen, for example, the housing inflation, rent inflation in areas north of Toronto, for example, where I live, but we've seen deflation in, prices and rents in other parts, in condo markets and big cities. So overall, in aggregate, the money supply that's been pumped in since March in response to the pandemic has not been is not likely to create inflation on a longer term window, because for one thing, it's being wasted in a lot of cases on speculative activities, which aren't actually going to improve productivity, or not going to actually improve wages. So that's just kind of financial froth that's ultimately not going to be sticky. And then you've got all the additional debt that's been added, which ultimately is deflationary. So I think the inflationary bits we're seeing right now are likely to dissipate as we go into the second half of the year. And we've had some backup in interest rates in the last, say, month or two. And what that does is that's just making, the yield curve is more positively sloping, which again is indicia of heading into a major market correction, not coming out of one. We're still in that part of the curve where the 2 and 10 year is just on an upward positive sloping angle, and that just suggests that borrowing costs in the near term are going higher. So of course you don't want to have, when you've got everyone borrowed to the hilt and barely covering their bills, any backup in interest rates becomes deflationary ultimately because it holds them back from further spending. So I think I just think that the backup in rates recently is not likely to persist, especially as we go into a repricing cycle in some of the assets that have become so egregiously priced.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.